Hello students, welcome to the lecture on Principle and Practices of Insurance. And after this lecture, we will be able to learn the following objectives. Explain defining risk, discuss management of risks, describe the evolution and meaning of insurance, explain the rights and responsibilities of the insurer, discuss the rights and responsibilities of the insured. Describe the role of insurance in financial system. Let's start with the concept of principle and practices of insurance. Risk is the fundamental element that influences financial behavior. In its absence, the financial system necessary for efficient allocations of resources would be vastly simplified. In that world, few institutions and financial instruments would be needed, and the practice of finance would require relatively elementary analytical tools. But of course, in the real world, risk is ubiquitous. Much of the structure of the financial system we see serves the function of the efficient distribution of risk. Much of the financial decision making by households, business firms, governments, and especially financial institutions is focused on the management of risk. Measuring the influence of risk and analyzing ways of controlling and allocating it requires a wide range of sophisticated mathematical and computational tools. Indeed, mathematical models of modern finance practice contains some of the most complex applications of probability, optimization, and estimation theories. Those applications challenge the most powerful of computational technologies. Risk management provides a comprehensive introduction to the subject. Presented within the framework of a financial institution, it covers the design and operation of a risk management system, the technical modeling within that system, and the interplay between the internal oversight and the external regulatory components of the system. The range of topics is broad but evidently carefully chosen for its applicability to practice.
Risk management. Hi, this is Marudhu Pandin here to give a quick intro of how to manage risks that occur during projects. So what is risk actually? A risk is something that may or may not happen. Let's go with an example. Assume that you have an important meeting to attend that you don't want to miss. To arrive at time you have to find all the risks that are lying ahead in your journey. You might encounter a bad traffic congestion or your car may break down due to flat tire. In order to deal with risk in anything, we need a set of tools and techniques for identifying and assessing these risks. Let us see a model of managing risk, what Barry Boehm calls as risk engineering. The stages are: 1. Risk identification, 2. Estimation, 3. Evaluation, 4. Planning, 5. Control, 6. Monitoring, and finally we have directing and staffing. Risk identification is listing all the risk that can affect the successful execution of the project. Risk estimation is about assessing the impact of each risk and their likelihood. Risk evaluation is about ranking the risks and determining the strategies for solving the risk. Planning is about developing plans to solve the risk and add it to the right place in the project progress to avert the risk. Control is the main function of the manager to minimize risks and react to the problems that might occur in the project. Monitoring is an ongoing activity to assess the importance and likelihood of the risk as the project proceeds. The last stage is the work of the manager to direct the staff and provide resources to them to tackle the risk. Risk engineering must be carried out by a separate team to effectively identify and solve the risks. These steps only provides a framework for managing risk. One should design techniques as per their needs.
Let us now discuss defining risk. Risk is part of every human endeavor. From the moment we get up in the morning, drive or take public transportation to get to school or to work until we get back into our beds, we are exposed to risks of different degrees. What makes this study of risk fascinating is that while some of this risk bearing may not be completely voluntary, we seek out some risks on our own, speeding on the highways or gambling, for instance, and enjoy them. In general, and risk management in particular. By equating risk management with risk hedging, they have underplayed the fact that most successful firms in any industry get there not by avoiding risk but by actively seeking it out and exploiting it to their own advantage. Risk is the uncertainty of the outcome with several possibilities. Risk is virtually anything that threatens or limits the ability of a community or non-profit organization to achieve its mission. Amongst very many risks which might be faced include the risk of a person being injured in by a motor vehicle, aeroplane, railway train, ship or boat. The risk of the premises of a business or any of its contents, money, furniture, machines, equipment, stocks of materials or goods for sale being damaged or destroyed by fire or water. The risk of farm or domestic animals falling sick, being injured or killed or stolen. The risk of money, machines, equipment, motor vehicles, stocks of raw materials or goods for sale or some other valuable items being stolen. Common features of risks, because there are so many different risks which might be faced and we have already described a wide variety of risks. What exactly constitutes a risk is not easy to define, and for that reason there is no one universally accepted definition. Risk is the inability to accurately predict the effects of future events which might result in losses. Despite the great diversity of risks, some of which we have already described apart from the inevitability of a loss, if an undesirable event occurs, we can identify certain other common features. There is the possibility, not a certainty, of an undesirable event occurring. There is unpredictability, that is, it is not known when the undesirable event will occur or indeed whether it will occur at all. There is uncertainty as to or the extent of the loss which will arise should the undesirable event actually occur. We consider these features of risks further later in this module. We also consider how different people have differing attitudes towards risks and why some risks which could be insured against are not insured. The concept of risk. Risk is the probability that an event will occur. In epidemiology, it is most often used to express the probability that a particular outcome will occur following a particular exposure. There are very few conditions that constitute a sufficient cause in chronic and infectious disease, a sufficient cause being one where a specific exposure will always result in a particular outcome. If there were, it would not be necessary to deal with risk, which often deals with varying degrees of necessary cause. A necessary cause being an exposure which must always precede a particular outcome, though it can also deal with exposures that are neither necessary nor sufficient causes. This brief report is to support the uniform use of a previously stated definition of a risk factor in an effort to standardize terminology for this conference. History of risk. For much of human history, risk and survival have gone hand in hand. Prehistoric humans lived short and brutal lives as the search for food and shelter exposed them to physical danger from preying animals and poor weather. Even as more established communities developed in Samaria, Babylon, and Greece, other risks such as war and disease continued to ravage humanity. For much of early history, though, physical risk and material reward went hand in hand. The risk-taking caveman ended up with food and the risk-averse one starved to death. The development of the shipping trades created fresh equation for risk and return, with the risk of ship sinking and being waylaid by the pirates, offset by the rewards from ships that made it back with cargo. It also allowed for the separation of physical from economic risk, as wealthy traders bet their money while the poor risked their lives on the ships. The nature of risk. Risk or danger is present whenever human beings are available to control or foresee the future with certainty. For example, the risks to a homeowner arise because neither he nor she nor anyone else can know for certain whether or not his or her particular house will be flooded, burned down, struck by lightning, burgled or vandalized. No matter how safety conscious the owner might be, the house cannot be completely protected from all those risks. In the same way, there is risk in running a business because no business person can guarantee that he or she will make profits rather than lose money from the activities of the business. Types of risk. There are several different ways of looking at risk, and different kinds of risks can be categorized by considering their effects. These are fundamental risks. These tend to affect large numbers of people, perhaps areas of countries, or whole countries, or even a number of countries or a geographical region. Their effects are either on the community in general or on groups of people, and they cannot be controlled even partially by any one person. Such a risk is present in the forces of nature. The weather, for example, cannot be controlled or influenced by individual action. Incidences of volcanic eruption, tidal waves, and tsunami, floods, earthquakes, and similar natural phenomena cannot be controlled, and the extent of damage devastation which they might or might not cause cannot be predicted. Another example of fundamental risk is the economy of a country. That is because the effects of, say, inflation, increases in costs, prices, etc., or mass unemployment are beyond the influence of individuals. Particular risks. In contrast, these refer to risks whose future outcomes or effects can be partially controlled, although not predictably, by individuals or groups of people. They arise, for example, from an individual's decision to drive a motor vehicle or to own a property or even to cross a road. Much depends on the individual's action and level of care or lack of care and attention. Because particular risks are the responsibility of individuals, each person must live with their consequences, although in many cases the effects can be alleviated by insurance. We say that such risks are insurable.
Strategic risk is probably one of the hardest ones to get your head around. But it's those big macro things that people don't normally think about. For example, if we as an employer aren't thinking about the kind of people we need in 2 years' time and training and developing them, the risk is, and doing something about it now, the risk is that we find out in 2 years' time we haven't got the people we need to run a business. So that's like a strategic risk. Well, I mean, strategic risk, there are many strategic risks. So, for example, we've seen the government has done some big spending cuts recently, and they're saying they're going to change the law in all sorts of ways, and that brings huge risks. So, for example, for academic institutions, universities, etc., they're finding that the funding structure for students is changing altogether. Those are huge strategic risks that they can do very little about, apart from worry, maybe plan a little bit, but that's a good example. And a new government might change the risk back and say, okay, we'll go back to grant funding and in the future, and that's probably a strategic opportunity more than a risk, but you never quite know where these things will go at times. Well, an example of financial risk is not getting paid. That's a classic one. So if we as a business we go to customers that aren't solid or aren't reliable or perhaps haven't got a good balance sheet or not financially solid, we might find that they go bust or they don't pay us because they don't want to. So that's a classic example of financial risk. Operational risk, well, clearly the classic operational risk in health and safety is health and safety orientated, looking after our people and making sure we don't hurt people as we go through and run our business. But there's a whole host of different operational risks, and I think as a classic example, if we're delivering a contract for a client, a customer, we might find that a small shipment or a small delivery doesn't arrive and it upsets the whole contract and the whole delivery. So you've got to think about where those risks might be and what you would do just in case that happened. What will we do? How will we solve the problem?
Now moving on to the next topic, we will study the management of risks. Risk management is the minimization of the detrimental effects of risk by identifying the risk, measuring the risk, and controlling the risk. Risk management is a central part of any organization's strategic management. It is the process whereby organizations methodically address the risks attaching to their activities with the goal of achieving sustained benefit within each activity and across the portfolio of all activities. The focus of good risk management is the identification and treatment of these risks. Its objective is to add maximum sustainable value to all the activities of the organization. It marshals the understanding of the potential upside and downside of all those factors which can affect the organization. It increases the probability of success and reduces both the probability of failure and the uncertainty of achieving the organization's overall objectives. Risk management should be a continuous and developing process which runs throughout the organization's strategy and the implementation of that strategy. It should address methodically all the risks surrounding the organization's activities, past, present, and in particular future. Supporting the organization's objectives by providing a framework for an organization that enables future activity to take place in a consistent and controlled manner. Improving decision making, planning, and prioritization by comprehensive and structured understanding of business activity, volatility, and project opportunity threat. Contributing to more efficient use, allocation of capital and resources within the organization. Reducing volatility in the non-essential areas of the business. Protecting and enhancing assets and company image. Developing and supporting people and the organization's knowledge base. Optimizing operational efficiency. Let's know the meaning of the evolution and meaning of insurance. Insurance is nothing but a system of spreading the risk of one onto the shoulders of many. While it becomes somewhat impossible for a man to bear by himself 100% loss to his own property or interest arising out of an unforeseen contingency, insurance is a method or process which distributes the burden of the loss on a number of persons within the group formed for this particular purpose. Basic human trait is to be averse to the idea of risk-taking. Insurance is the science of spreading of the risk. It is the system of spreading the losses of an individual over a group of individuals. Insurance is a method of sharing of financial losses of a few from a common fund formed out of contribution of the many who are equally exposed to the same loss. What is uncertainty for an individual becomes a certainty for a group. This is the basis of all insurance operations. Thus, insurance converts uncertainties to certainty.
Meet Jim. Jim works hard as a successful professional in the public service so that his family can enjoy the finer things in life. One day, Jim received terrible news that his neighbor Todd passed away, leaving behind his wife and children. Jim watched as Todd's family, overwhelmed with expenses, was forced to sell their home. Seeing this made Jim realize that if anything happened to him or his wife, his family could face the same situation. So Jim began to explore ways of protecting their lifestyle. He considered living in a bubble to avoid germs or contagious illnesses. He thought about hiring a security team and building a moat around his home to protect them and their fortunes. He even thought about taking excessive amounts of vitamins and supplements to extend his lifespan. Luckily, like you, Jim has access to Service Plus, which offers a fantastic lifestyle protection plan. Jim learned that this life insurance, available for members across Canada, spouses and their dependents had the lowest monthly premium available, anywhere. Jim was also relieved that applying for this life insurance wouldn't add more work to his busy schedule. It was as easy as filling out and sending in a simple application and questionnaire. Jim made the smart choice and took advantage of the Service Plus Lifestyle Protection Plan group life insurance. Now, Jim is worry-free, knowing that if something happens to him or his wife, their family is protected.
The main function of insurance. The main function of insurance is to compensate the insured, the person or organization who effected or took out and paid for the insurance for loss or damage caused by the risk insured against. In many cases, the compensation by the insurers takes the form of indemnity, which involves placing the insured in the same position financially as he or she or it was in immediately before the loss or damage occurred. A payment of money equal to the value of the item lost or damaged. The replacement of the lost or damaged item. The repair of a damaged item. Restoration, for example, rebuilding a house destroyed by fire. History of insurance, life insurance. In 1818, the British established the first insurance company in India in Calcutta, the Oriental Life Insurance Company. First attempts at regulation of the industry were made with the introduction of the Indian Life Assurance Companies Act in 1912. A number of amendments to this act were made until the Insurance Act was drawn up in 1938. When the act was changed in 1950, this meant far-reaching changes in the industry. The extra requirements included a statutory requirement of a certain level of equity capital, a ceiling on shareholdings in such companies to prevent dominant control, to protect the public from any adversarial policies from one single party, stricter control on investments, and generally much tighter control. In 1956, the market contained 154 Indian and 16 foreign life insurance companies. Business was heavily concentrated in urban areas and targeted the higher echelons of society. Unethical practices adopted by some of the players against the interests of the consumers then led the Indian government to nationalize the industry. In September 1956, nationalization was completed, merging all these companies into the so-called Life Insurance Corporation.
This is Bob. One day Bob met Sue. They fell in love and decided to get married. They had 2 children. Oh, and a cat called Max. They decided to buy their first house. So they took out a repayment mortgage for £150,000. But Sue thought, what if something was to happen to one of them? How would they pay their mortgage? For peace of mind, Sue and Bob took out a decreasing term assurance policy. This was for a 25-year term, which matched their repayment mortgage. This meant that if something was to happen to either of them over the term of the mortgage, the remaining balance would be paid off. The policy decreased in line with the mortgage, giving Bob and Sue complete peace of mind. With level term insurance, the amount of money paid out stays level. This is often used to cover an interest-only mortgage. So then, Bob and Sue didn't have to worry about the future.
Insurance is a contract in writing under which insurer agrees in return for a consideration premium to indemnify the insured against the loss suffered on account of an uncertain future event. Life insurance is a contract for payment of a sum of money to the person assured on the occurrence of the event insured by the contract. An insurance policy is a legal contract. There are steps someone must take to fulfill responsibilities as an insurance holder and steps insurer must take as well. The advantage of obtaining insurance is that it allows the pooling of risks and reduces the probability of one party bearing the entire cost of loss. Responsibilities. Someone should provide complete and accurate information to insurer. Someone must pay his premiums on time following the grace period. If someone does not, policy may be cancelled for non-payment. Coverage will stop and someone will no longer be protected. Someone must notify his insurer about any changes in circumstances that might affect the risk insured. Someone must maintain property in good condition. Someone must take reasonable steps to mitigate damage. For example, if home is being damaged from water leaking from a pipe and someone does not turn off the water supply to the pipe, coverage may be limited. Rights. One has the right to be fully and clearly informed about policy, coverage and the claims settlement process, about how insurers calculate prices and about who is providing compensation to broker or agent for the sale of insurance. One has the right to professional service from agents and brokers who are well informed about the products they are selling and who treat one with fairness and integrity. One has the right to timely complaint resolution if one is not satisfied with the service one has received. If one have a complaint, contact provincial regulator. One has the right to privacy. Personal information may not be disclosed to anyone except as permitted by law. As a smart consumer, all should be aware of their duties and rights about policy coverage and claims. Duties. When one buys a policy, fill the proposal form himself correctly and truthfully. It is the basis of the insurance contract. Do not leave any column blank. Do not sign a blank proposal form. Someone will be responsible for any information in this document as it bears signature. Disclose all material information about the risk someone wants to cover. Select the term of the policy as per needs after one buys the policy. Once the proposal is submitted, one should hear from the insurance company in 15 days. If not, take up the matter in writing. If any additional documents are asked for, comply immediately. Once the proposal is accepted by the insurance company, the policy bond should reach within a reasonable amount of time. If not, contact the insurance company about it. Rights. Someone has the right to cancel a life insurance policy within 15 days from the date of receipt of the policy document. Insurance companies are major investors in financial markets. On aggregate, the largest investors worldwide are investment funds, followed by insurance companies and pension funds. Moreover, a part of the assets under management of private equity and hedge funds are owned by insurance companies and pension funds, making these investors major players in global financial markets. These aggregate numbers hide some differences across major markets in the relative importance of these different groups of financial entities. For example, insurance companies are particularly important players in relative terms in some European markets and in Japan. Insurance companies have the capacity to adopt investment strategies with long-term horizons. Insurance companies, especially life insurance companies, are financial institutions with long-term liabilities than commercial and investment banks, and thus they have the capacity to adopt investment strategies with long-term horizons. To the extent that they adopt such strategies and do not sell into falling markets when many other types of investors do, they are a stabilizing element of the financial system. Most parts of the insurance industry appear to have acted as a stabilizing element in this sense during the current crisis. Now in the end, let us summarize what we have learnt in this lecture. Risk is the fundamental element that influences financial behavior. Every non-profit organization faces a certain amount of risk, whether it's ensuring the health and well-being of their volunteers or protecting their premises. Risk management is the minimization of the detrimental effects of risk by identifying the risk, measuring the risk, and controlling the risk. The Indian Insurance Companies Act enacted to enable the government to collect statistical information about both life and non-life insurance businesses. The risks facing an organization and its operations can result from factors both external and internal to the organization.